The third method for calculating depreciation expense is double declining balance method. Using this method, your depreciation expense is equal to double declining balance rate multiplied by the book value. You have to know how to calculate the double declining balance rate. The easiest to do that is to take 2 divided by life in years. And I know here it tells you to use straight line rate times 2, but usually all your exam questions and your quiz questions will give you the life in years. So just take 2 divided by life in years, that is your double declining balance rate. Once you come up with that rate, that is the same rate you're going to use over the life of the asset. Now, book value changes every year. Book value, as you know, is calculated by subtracting the accumulated depreciation from the cost of the asset. So in year 1, you take your cost, and since there was no accumulated depreciation for the very first year, your book value is equal to your cost. But for the second year, you have to remember that your book value is your cost minus the accumulated depreciation, which is the depreciation in the first year. Let's do an example next. We're going to use the same example here as for the straight line method, but we're going to calculate depreciation using double declining balance method. So it says on 1/1/2012, Medina Inc. purchased equipment for $18,000. The equipment has an estimated useful life of 5 years and a residual value of $1,000. What is the first year's depreciation expense using double declining balance method? You know that you calculate your depreciation expense by multiplying your net book value by the double declining balance rate. First, let's look at the net book value. What is your net book value? Your net book value is cost, which is $18,000, minus accumulated depreciation, which is 0 because this is the very first year. Your double declining balance rate is calculated by 2 divided by estimated years of useful life, which is 5. In other words, your depreciation expense is $18,000 times 40%. 40% is your double declining balance rate. Remember, you're going to use this rate for over the entire 5 years of the asset's useful life, which means your depreciation expense for the current year is $7,200. Let's do a journal entry for this. What you're going to do is you're going to debit depreciation expense for $7,200, and you're going to credit accumulated depreciation for $7,200. So, what happened to the residual value of the asset? Whenever you're using the double declining balance method, you do not use the residual value in the first year. You ignore the residual value until the last year of the asset's life. Again, you ignore the residual value until the very last year, which is year 5. The residual value comes into effect on your last year. In that example we did, it was the 5th year. In that 5th year, you're going to take the book value at the beginning of the final year, which is the book value at the beginning of the 5th year, and then you subtract your residual value, and that gives you your final year's depreciation. Again, you ignore the residual value until the final year. In the final year, you take your residual value and subtract it from your book value, and that gives you your final year's depreciation expense. Again, when you're using double declining balance method, in the first year, your depreciation expense is based on the asset's full cost. But the final year's depreciation is a plug amount, and basically what you do is you take your book value, subtract your residual value to come up with your final year's depreciation expense. As you know, GAAP allows us to use any of the 3 methods. So let's see which companies would use straight line, which companies would use units of production, or double declining balance. Straight line method is best for assets that generate revenue evenly. This applies to most assets. And also it best meets the matching principle. Units of production is good for assets that wear out because of use. Typically all the construction equipment, the Caterpillar machines that you see for road construction, those use units of production. Double declining balance is best for assets that generate revenue early in their useful life. Also, whenever you're using double declining balance, your depreciation expense is much higher in the earlier years than in the later years. You need to understand that the total depreciation expense over the life of the asset is the same for all three methods. However, for double declining balance, most of the depreciation expense is allowed to be subtracted in the first few years. The benefit of that is if you have a high depreciation expense, you have low net income, which means you have to pay less tax. As a result, IRS lets most companies use double declining balance for shorter lived assets. Does that mean you can use one method of depreciation when you're preparing your financial statements and you have to use another method of depreciation when you're doing your tax returns? Yes. Most companies use straight line method for their financial statements, but when they're preparing their tax returns, they have to use the IRS guidelines. Shorter assets have double declining balance method and longer assets have straight line method.